we're saving this for posterity. My name's Frank Fahey. Welcome aboard our presentation today. I'm impressed that everybody's here. It's, boy, it's been quite a 2 weeks in the markets. It's sort of like if you don't like the weather, wait a few minutes, it'll change. I think this may be the 11th day in a row we've had a triple-digit move on the Dow Jones. There may have been one last week that I somehow missed, but it's made it difficult for trading. Now, originally, my presentation, when I talked to Jim Graham last week about what I was going to present, I thought selecting an expiration month because I had 3 different expiring months sitting in my positions last week, and one of which was the expiring June, and that behaved just as a weekly. And I went from having a great position to literally having my face ripped off on Thursday, and it was my own fault. You know, there were certain things I could have done to manage risk where I said, hey, and here's an example. I was long the 157 put and short the 161 put in June. I could have bought that in for 15 cents, okay, or rolled my 157 put up to 161. Well, I mean, we closed at 159. How would that have been for a trade? So last week's lesson was, hey, if I think it can't happen, I probably should do something to in response to my overconfidence. But it's going forward on selecting an expiration month and talking to the many people that called me last week because, as you know, I've often said to all of you who I've mentored, when in doubt, when you have a concern, break the glass and call me, because a few moments it can make a difference. And I saw some confusion about Greeks last week, and I went in the direction of in putting this together, more in the direction of Greeks. So let's see if I can get this to go. Aha. Okay, who am I? Most of you know who I am. Frank Fahey. I went down to the floor of the Chicago Board Options Exchange in 1984. That seems like an eternity ago. I came there after being in sales for nearly 10 years with digital equipment and IBM. I sold for them. In the meantime, gosh, I've traded in a number of different environments. I traded primarily in the equities sphere. I traded, gosh, Revlon, Superior Oil, some names you don't even hear anymore because they were taken over. I was trading Rockwell when the Challenger went down. I was on the floor trading Exxon, Burlington Northern, and Cigna, and Polaroid when we had the crash of 1987. I traded, the dot-com boom, and I traded the dot-com bust. I had big positions when on 9/11. So I've seen, gosh, so many different things and made and lost money in so many different ways. Over time, I progressed from being a premium buyer to a premium seller. That's my own risk-reward preference. And gosh, we're having a pretty nice rally in the S&P and the Russell right now. But so that's who I am, and I do consulting for a number of different groups. You may see me in your town presenting, if you're in a larger town, for the Options Industry Council. I present on behalf of the ISE, the BOX, the Boston Options Exchange, the BATS out of Kansas City, and the MIAX, which is a new exchange. So that's where I am, that's what I'm doing. My dad had a favorite saying which said, chance favors only the prepared mind. And the most basic way of preparing my mind is for options was learning the Greeks. At first, when I first started, we really only knew delta and gamma. And we had to estimate it basically during the day because I never got any real-time runs. It was anybody's guess on what your actual position really was. The concept of Vega was unknown. I mean, it was an options as a strategic investment, but it was something that I couldn't even get on a daily basis. The one number we did get was raw premium over parity. And to be quite honest, my first couple of years, I really didn't understand it. I was a slow learner. Until I understood Vega, all the Greeks, and implied volatility, I was a bit better than a break-even trader. But Louis Pasteur said chance favors the prepared mind, and we favor or prepare the prepared mind, or our minds, using tools like OptionVue, going through and saying, what if, what if, what if, and constantly slicing and dicing potential positions and ongoing positions. So this may move. Okay, so and most of you have been here before, know what the prepared mind is. It's common to high achievers across high-risk professions, and we're constantly honing and expanding our knowledge base. And basically, it's anytime I see something new, it's what if, what if, what if. I mean, Conrad Sullenberger, the guy who landed the plane on the East River, didn't think about landing that plane on the East River the one day he had the opportunity. As he flew out of, gosh, I guess it was probably LaGuardia, he was prone to think, what if, what if, what if. Actually, it might be, I don't know the names of the airports in New York anymore, but you guys know what I mean. So, okay, we're going to do the disclaimer here. Anything that I use, and I'll go between our presentation here and OptionVue, is just for teaching purposes. Just because I key something in, do not assume that it's a position you want to put on. Anything I do here is purely for teaching purposes. In addition, I do not include commissions. All of us have different commissions. One thing I would like to highlight is all commissions are negotiable, okay? And I can't tell you what you should be paying, but do not be afraid to question the commission rate. At this moment, at 110, the loss on the E-mini has gone into one digit, 9.75. So that's about over a 20-point comeback, over a 1% comeback. And so, and that's volatility. That's statistical volatility. That movement, the raw movement on a daily basis, is what we call statistical or historical volatility. Okay, here are the basic facts. All option strategies work. It's as true as any statement I can make about options. Each of them describes a specific set of expected outcomes over a change in price, a change in volatility, and that's implied volatility, and change in time. Okay? And the most important thing of all is no strategy works all the time. Now, there is one strategy which I consider one of the most important in our quiver that does the same all the time, and that is do nothing. And it's generally probably the most underrated strategy that we have. Okay? So, and one thing, I'm going to do some real quick housekeeping here because it's a problem I've seen before, and maybe we'll do it as I get a little cash. Okay. We're going to talk about, I'm going to start with the option pricing model because everything flows from there. Okay, it's the basis from which all the Greeks are determined. So that's the delta, gamma, theta, rho, vega, they're all determined from the variables that are in the options pricing model. And it changes in any of those variables can change a theoretical option price. Understand, it's important that we all understand that the theoretical option price is based on inputs that we put in. The real option price comes from an auction marketplace where we have buyers and we have sellers. Remember that there truly, when you come down to it, is no such thing as an undervalued or overvalued option. It may be, in the broad scheme of things, overvalued or undervalued. You will expect it to go in one direction or another. But my experience is that if it's trading $1.25 and you're long 100 at $1 and your theoretical price is $1.25, you're probably wrong. You aren't going to be able to use that theoretical value to withdraw a theoretical check from your trading firm, whether it's Thinkorswim, Options Express, Options House. They just aren't going to let you do it, okay? And the model is going to allow you to do a risk assessment. I look at not only the Greeks themselves, but the picture, which is a visual, a graphic analysis of what our risk-reward parameters are. And so the Greeks that we get are used to measure the sensitivity of an option price, an individual option price, to changes derived from the model, okay? And implied volatility is calculated from the model. And trust me, a lack of understanding will definitely cost you money. And one thing that I like to do is I'll sit there and I'll say, where did I make and lose money? If you remember, if we go back, okay, movement in price is described by delta and gamma. Changes in volatility, we get our exposure from a risk-reward standpoint on the vega, and time is theta. I generally can ballpark and do ballpark every position every day, throughout the day, on where am I making or losing money, okay, which is it based on the change in price, which is delta and gamma, change in implied volatility, which is vega, and change in time, which is theta. Now, that's one day at a time. Oops, sorry about that. I'll hang up. So, and it's important. This is the foundation of everything that we need to know. And one thing I get from people at times is they'll say, Frank, why do I need to know the Greeks? You teach us, specific strategies. Well, those strategies are foundations from which you move off from, okay? As I said, all strategies do not work all the time. And based on the core strategies we teach, you will develop a nuanced difference, which is based on your own personal risk-reward comfort zone. My comfort zone is not the same as Steve Papali's, and I see a number of people here who are turning out to be some pretty good traders and developing an understanding. But gosh, the Greeks are the core of what we do, understanding that. And it's not really that complicated. It's like, oh my gosh, I can never learn that. And it took me a while. But you guys have tools that I never had, even when I was still on the floor in, gosh, I was trading on the floor until 2007. I mean, I had no tools on the agricultural trading floor, which was a sort of a unique experience. So, and when I started off, I had a calculator, and I had trading cards, and I would get one run of theoreticals based on, quite frankly, a pretty crude model. Now, one thing I'm going to go through right now is there are settings in OptionVue which are crucial to your success. When I say settings, you can choose a number of settings which will directly affect the Greeks that you get. I use the same settings all the time. I'm going to show you these settings. They will be. I did remember to hit the record button, so you'll be able to go back and review. But these are very important. I'll find out at times that they have changed. We can go through, and I'm on the main matrix page. I'll go through and I'll go View, Default Models. Okay. People will argue, and I get, gosh, you know, every time I go and do something for the Options Industry Council, I'll have somebody that, you know, went to the Beijing Institute of Technology or MIT or Caltech that will want to argue about which one of these to use, which option pricing model. And they'll tell me that I don't understand how I'm supposed to use option pricing models, which I find sort of mind-boggling since I have been intimately involved with them for almost 30 years. The one thing I can say is use the same one all the time in OptionVue. It's very important. So I choose Yates. I like Yates. Okay? See, this A here will go through and check and see the settings on any asset files where I have positions. Okay? Delta Gamma. I use True Delta Gamma for the indexes I trade. The equity indexes, I find this reflects the reality as I see it the best. And as we go through, I go up, look, I had made a mistake there. And I guarantee it was on the SPY. It was because I showed somebody what to do. And I'm going to go through this pretty quickly. I do not use skew curves. What that is, using a combined call put skew, I don't do that. There's a radical difference between call skew and put skew. And the quickest way to look at this is we'll look at the SPX right now. Okay? We're trading 1560. Oh, what did I do? Who knows what I did? Okay. 1560. So let's go, oh no, 1580. That shows how I hadn't opened it for a while. So if we go 100 points higher, okay. Okay, I have so many things going here, guys, that I think I'm stripping the gears right now. Okay. But if I go, okay, 100 points higher to 1680, that call is trading 380, 390, which is 345. I go 100 points lower to 1480, put 100 points away, is trading 1540, 1670. Does that seem possible? Yes. More than 5 times the price. We do not want to calculate our skew based on this number and this number here, okay? I want everything to be calculated looking at puts and calls separately in the calculation of the deltas and the rest of the Greeks. So, as I move along, if anybody has any questions, feel free to ask them. I'll take a break here right now if anybody has any questions. Okay. We'll move forward. So we're going to go back to View. And I'm beating a dead horse to death, but I find, gosh, mistakes are made. Make sure slippage is always none. It's going to assume that you can buy at the midpoint and sell at the midpoint between the two options. If you have it set to hit, bid, and ask, it's going to calculate everything assuming that you are going to buy on the offer and you're going to sell on the bid. Your profit and loss numbers will not reflect reality. In addition, I use bid and ask divided by 2 for anything I use here. That is the quick and dirty of it. The only other thing to know is if you go in here and we go View, Default Models, I can go into, go to Model. There's something called volatility here. I'll check the settings and I always make sure it's variable. okay, and that's what I use. That's the quick and dirty, and we're going to go back to, okay, so strategy selection, okay, and I'm going to harp on this: price, implied volatility, and time. So the most important factors in any market are price, movement, or action, and that's delta and gamma, measure that, time, which is theta, and implied volatility. Over time, all of you will find out whether what kind of trader you are, and they basically fall into two camps. You're either a premium buyer or a premium seller. You know, I like to buy calls or I like to sell calls. So we could look at it as being, I like to trade credit spreads or debit spreads. Credit spreads are premium sellers, debit spreads are premium buyers, okay? And do we have directional or non-directional expectation? Now, non-directional is something that really doesn't seem to make a whole lot of sense to me, and I use it. I'm guilty of using that term. What makes more sense to me is range trading. Okay, I expect something to trade in a specific range. And quite often we look at it as standard deviations. And that's what implied volatility is basically talking about, is expected standard deviation, expected range based on the implied volatility. There's something called statistical and historical volatility, which is the movement, usually the high and the low of any underlying, based on movement in on a daily basis, a day-to-day basis. That is not the same as the implied volatility. Here is the options pricing model. Now, look at this mess. Do we need to know it? No, you don't need to know it. I have found that success in options trading comes from building a discipline and reducing something to the lowest common denominator. I mean, we are assaulted with noise every day. I mean, quite frankly, it's pretty amazing, what we see. We all have watch lists, and we have that information coming. We have the individual stocks we trade. There's, gosh, CNBC, there's innumerable newsletters or people that are sending us stuff. You know, how to make money on weeklies, how to do this, how to do that. Okay? The whole thing is there's only a few things we need to know. The stock price, the strike price that we're going to trade. Interest rates are so close to zero that it's actually been a non-issue for a number of years. When I first started trading, broker call rate, the interest rate, was, gosh, anywhere from 10 to 16%. Interest rates mattered and mattered a lot. Dividends matter, okay? One thing that, for those of you trading equities, there's the comment section of OptionVue. It is very valuable for putting down here. Oh, I don't have alerts. I'm not trading any equities now. I gave a lesson on alerts just recently. We have something here called, of course I can't find it. I would have thought it was called comments. Notices. Notes. See, I knew I could come up with it. Where I can put in earnings on 7/19 before market close, or before market opening. Okay, and I'll put that in. Anything that I'm trading, and this is really important. Gosh, I still haven't even gotten to the Greeks. Write that down. Know, what this is going to be, and do not allow yourself to be caught by surprised by earnings or dividends. If you're trading equities, put them in the notes section. Okay. Time to expiration, that's a constant in volatility. Okay. So we have all these and they lead to a fair option value. And a number of different trading programs can calculate option fair value, option theoreticals. I'll tell you what options are worth. Options are worth what people are willing to pay for them, or what people are willing to sell them for. So you can have, Cox Rubenstein, Black-Scholes, Yates. There's binomial pricing. There are so many different pricing systems. Our pricing, the most important thing is we use the same. Okay? But if we go through these things, we know the price is determined by the auction marketplace. We know the number of days till expiration. We know the strike, because we selected it. We know the risk, what they call risk-free interest rate. Right around now, people are using, they were using 1. But, I mean, that's pretty close. And you know the dividends. And we know the actual price. So when we talk about theoretical value, you're assuming the volatility, and people will throw in the statistical vol or something like that. But that's not really what happens. The classic model says if we know all these, we can come up with a theoretical model. The fact of the matter is we don't know what the volatility is. We do know the actual option price. So what happens is we have these 5 factors and the actual option price, and we can solve for volatility. So, and when we say implied volatility, it means that is the volatility as implied by the actual option price. Okay? And from this, we can get fair value. Who cares what fair value is? Fair value is whatever people are willing to sell it for, or people are willing to pay for it. We may say, hey, we'll look at a price range and say we're at the bottom or the top of a price range or a volatility range and make decisions on that. But fair value, But we do calculate based on all this information and the option price what the Greeks are, which are delta, which is the movement and the change of the price, gamma, which is how much delta changes for a 1-point move in the price, theta, which is your exposure to a 1-day move in time. Your account either gains money or loses money. Vega, which is exposure to a 1% move in implied volatility, and Rho, which is your exposure to a 1% move in interest. Somebody just asked a question here. Okay. What do I put for future pricing on the option view price model? Okay, that's sorry guys, I'll see what I do. I believe I use bid plus ask divided by 2. View default models. Except futures bid asked. I use bid plus ask divided by 2. Does that answer your question? Sorry, guys. If I don't answer a question when it happens, I'm not going to answer it. I'll get to it. Okay, so we'll go through this. Delta is the sensitivity to the movement underlying. It's the rate of change. Gamma is sensitivity to movement of the delta, okay, of the underlying. That would be the rate of change or rate of change. Some people will call this acceleration. Theta sensitivity to time, Vega sensitivity to implied volatility, and Rho you can ignore now, okay? But you should be aware of it. It's really important to me that you guys learn the Greeks. Okay. Okay, one thing I'm going to show you here, and these are some older slides I put together, but I did such a good job of putting them that I'm going to use this, okay? Delta. One thing I want to show you here, and you may find interesting, we have the 580 calls and the 580 puts. Look at this delta right here, okay, and right here, 47.1 and 52.9. It adds up to 100. Last time, oh gosh, I think a week ago or 2 weeks ago, I talked about put-call parity, and that talked about the relationship between the individual options, okay? But if you sold one of these and bought one of these, your delta would be 100, okay? But one thing I want you to look at is if we look at different months, you'll notice that the delta is different, okay, depending on month, and the gamma is different. The closer you are to 0 on day till expiration, the quicker it will accelerate. So the higher the acceleration, or the number, the higher the acceleration of the price. So in this case, the delta is going to move by 0.59 for every point it moves. That's part of my concern with Greeks, or with weeklies, because in that week, gosh, small movements in the underlying can end up being major movements in equity because of the fact that a delta can go from 0 to 100 back to 0, where 3 months out it may go from 55 to 45 back to 55. So be aware of the risk entailed with trading weeklies. My personal opinion, and this is, I mentioned I started off as a premium buyer. I was one my first 3 years as a trader. The next nearly 20 years I was a premium seller in the pits, except for the front month, final week. At that point I was a premium buyer because I could define what my risk was. And my risk was that small amount I paid for a weekly. That's me. There's some people that claim that they make money doing it. Okay? I would have had a great week last week if I had gotten out of my June positions on, on Wednesday before the big move. And quite frankly, I ruined a good month or a decent month by doing that, okay? So understand that we have movement here. And I'll set this up. I generally use a 6x1. But the market price is that bid plus ask divided by 2, okay? Mean implied volatility, notice they're all different. If I had clicked uniform on the, it would have been 35.2, or actually it would have been 38.7 if I had combined put call skew. On the calls it would have been 37.4, and the puts it would have been 40.4 if I hadn't clicked it. Okay? And this graph is going to show us, you'll notice that we have positive, okay, the delta is here is 100 when we're clicked here. Oh, geez, Frank. Okay, the delta here is not 100. Okay, because the solid line is t plus, or the dotted line is t plus 0. This is at expiration. So whatever I have is going to behave like stock. 100 shares of stock above and below, because you'll notice I'm long a put and long a call. And so that shows how quickly things can move when you're short something, because that can happen. We'd end up with a frown if we were short. Do we have any other questions? Okay, I'll keep moving. One thing I want to talk about delta, and I'll go back. See if I can get there. Some people look at this number here in delta, and I didn't, okay? We'll use 30.6 here, as being the probability that the stock ends up in the money, or this option ends up in the money, okay? Or the 550 put ends up in the money would be around 30%. the people I know that use it as such are fine traders, and it's how it makes sense to them. In the grand scheme of things, it's not so far off that it doesn't make sense. Remember what I said, a lot of what we do, or a lot of our success will come from filtering out the background noise and reducing everything to a lowest common denominator. So I said this to a fellow mentor the other day, and they said, BS. And I said, you know, it's not that far off to where it really is BS. And if it helps one of us understand risk or develop our own individual risk-reward comfort zone, it's very important. Okay? So now we'll look at gamma, and it's the rate of change of the delta of the option as the underlying moves a point. Okay? And out-of-the-money calls have deltas less than 50. In-the-money calls have deltas greater than 50. Okay? So as the market moves, delta of an option changes. And the amount that it changes is the gamma. Okay? So if you have a 25 delta call worth $3 and a gamma of 2.5, the stock up 1 point, okay, it's going to be worth 3 1/4, and it's going to have a delta of 27.5. So that's 25 delta. That's how much the stock would, if it moves up $1, the call will move up $1 or a quarter, because it has a 25 delta, so that call is worth 3 1/4. The 25 delta on the move up would then be worth 27.5. Okay, if we move it up another point, it'll be approximately 350, and a delta of 30. Okay, and if it goes up yet another point, the price will be actually we would have called that something else in the old days, but because we priced in teenies. But you'd add this 30, which is actually 0.3 to that, and you'd be 3.825, and the delta would be the 30 plus the 2.5, 25 delta. Now, okay, so when you have long calls or long puts, you are long gamma, okay? If you are short calls or short puts, you are short gamma. So if you are short gamma, as the options go up, you get shorter, and as they go down, you get longer, okay? This is a short gamma position. Actually, we'll go back. This is a long gamma position. It's a smile. So as we go up, you get longer, okay? As you go down, we get shorter. And you can see these numbers here. The deltas go down, the deltas go up, okay? Okay, come on. Why do I'm always somewhat challenged. Okay, and you'll notice, look at this. Here's another example of the Vega. Okay, we'll go back. Excuse me. I'm trying to find this. Here's the short gamma position. Okay. You'll see the gamma changes and actually goes down as you move away from the strike price. Okay, quite often we have complex positions with more than just 1 or 2 options on it. In addition, you'll notice that as with a negative gamma, as the price goes down, we get longer, and as it goes up, we get shorter, which means you're going to lose money. A lot of what, and this is how I look at things and how I model things, is I'll sit here and I'll say, I want to keep it under the curve. I want to keep this black dot, actually, I want to keep it above the line, and I want to keep it in the curve. Now, it's hard to, or under the curve. It's hard when you have T+0 to keep this under the curve, okay? But I want to keep it between these wings, and it's always an exercise. What if? What if? What if I move to the left, you know, to 540? What if I move to 620? What do I do? How do I adjust the position? What if, what if, what if? So traders are constantly sitting there, and I trade all day long, every day, going, what if this happens, what if this happens, what if this happens, okay? So that's what's going on there. Boy, we're getting quite a rally now, still. Okay, so now we're going to talk about, okay. I have such difficult time with maneuvering here. Okay, Vega measures how an option's value changes with respect to a change in implied volatility. Okay, you'll notice here that there's significant differences in implied volatility. Okay, the sensitivity to implied volatility. You go out a month, it has 3 times. So this one moves, implied volatility moves $1. Okay, this moves from 35.7 down to 34.7. I'm going to lose $24. And gosh, Frank. Okay. And remember, if it goes down a point, that's -1 times 24.2, -1 times 75.4, -1 times 137. Now you'll say, well, Frank, how does this help in strike selection? Right now, we're sitting at some pretty high volatilities, or have. I mean, and the VIX was up, gosh, 1.5 today, and it's down 0.18 right now. But if we look at this again, we'll look at the SPX, and I'll add weeklies, define, include weeklies, and we'll add a few more. We can look at something, where are we? We're at 1580, so we'll just look at maybe, let's say we sold something around a 10 delta. We'll go to, oh, now here's another thing I want you to keep in mind. Just words of wisdom. Look at volume. There's pretty good volume here, okay? But as you start moving out, you notice the farther out you move, the less volume there is. In addition, you'll notice that the difference between the bid and the ask, $1.70, $1.50, $1.40, $1.20, 75 cents, okay? So understand that there's going to be slippage. Slippage is how far from the midpoint you're going to have to trade it to get filled, okay? So I'll tend to trade these front 2 months the most often. But so if we look at Vega here, you'll notice that the deltas are a bit different. Go to 1580. But we'll go, let's go 50 points out. We'll go to 16.25. Look how this changes. 35, 40, 45. Okay? You're going to see that your delta, the farther you move out, the more, or the flatter your curve is going to be. In other words, it's a way of controlling delta and gamma, okay? Here, and we'll look at gamma. So moving farther out will control your exposure to delta and gamma, or to, in other words, movement and price of the underlying, okay? The gamma's higher, the delta's lower. And as you go out, the gamma goes down at the same strike price, and the delta goes up. So that means that for every point it moves, this delta is going to move less, which means your dollar exposure or risk is going to be smaller as you move out. This is an important concept to keep in mind, okay? So, and just very important. Now we're going to add Vega in, okay? And remember, that's the dollar exposure to premium. Let me show you something here. And this is why I had to leave the floor. I don't track as quickly as possible, as quick as I used to anymore. Vega basically is a way of converting the premium in a call, the extrinsic premium, okay, that difference between what the call's really worth and the juice or the premium you pay for owning it. You look at this. So the Vega here is 132, 218, 294, 343, 434. So if I'm looking for movement in volatility, and we'll look at the volatility, MIV, okay, then if I'm looking for a movement in price and I have a directional bias, I might want to trade something a bit closer in, maybe even a weekly. And I thought I added weeklies, so we'll go back to defined. Okay. So I mean, you'll notice here at 1625 we have 77 versus 214. I'm not going to get a whole lot of bang for the buck on this from a Vega standpoint. You'll also notice that the delta is only 19 versus 33 here. So selection of the month really makes a difference. You'll also notice that the movement, if we started overlaying, and if we just went, your losses will be amplified by the fact that your gamma is so much higher. So if and bear with me, we're going to click this, and we're going to analyze, close, and we'll buy one out. Of course, I lose track. Oh, I did buy a 1575. I bought a 1575, and I thought 1675. We'll buy one. Analyze. Now we'll analyze. Close. Who knows what happened? One. Analyze. Superimpose. Ignore this here. But there's a significant difference. I expected more. But things will change. But in selling these, you need to be careful because the acceleration, you can lose money quicker, quite frankly. And make it quicker. But you'll know this premium will move, and it will move away quicker. So let's go back to my presentation. Okay, so you'll notice here's something with no volatility change. Okay, this is something. When I do OptionVue, I step through the lines. These lines are time. Okay, the difference, and then we'll look at a price here. My P&L here would be 1414. I'm long delta. I'm short theta. Okay, that means every day this $58 in negative theta means that I'm paying $58 a day, $58.32 to own the position, and my Vega is 57.1. So visually, Vega is going to be how much the line moves up or down due to a volatility change. And gosh, okay, so if I go +1, okay, the volatility would move up $57 across the board here. If I go -1, it's going to move down. So that's one thing. For example, I'm looking at the RVX here, and it's 22.53. And I would have put on, when I was putting on positions this morning, I was looking at how does this position look down 1 point, down 2 points, down 3 points, and volatility, okay? And the way I look at volatility is I can look at a volatility chart, and OptionVue is not this slow. It's my system. I have, going through the same router, I have 2 computers with 6 terminals, and I'm running multiple. But here, you'll notice that the red, which is, we're up pretty high here on implied volatility and statistical low, okay? And I expect that you'll notice that we've been sitting at, geez, around 12 seems to be where we revert to, and we don't stay up too high too long. Okay. Geez. Oh, we'll find this somewhere. Okay, rows changes how much options value changes with respect to a 1% change in interest rates. Now, here's one thing that I would suggest, if you want it, I'll send this to, well, you can send me an email at frank@discoveroptions.com. This is something that I got from the Options Industry Council. And it was a nice graphic of explaining what happens with when, you know, stock price goes up or stock price goes down to delta, what dividends do, changes in strike price, vega, theta, and rho. It's a nice little cheat sheet. But all of these, you know, thanks a lot, people, but all of these have a impact buying which expiration month you want to do. So if you're very and it depends on the strategy. Remember, I said at the beginning, the strategy depends on what scenario we've painted in our head, what we think is going to happen to the underlying, the price of the underlying as far as movement of the price of the underlying. We think it's going to move in one direction or another, or stay in a range. What's going to happen to implied volatility? Is it at the top end of its range or is it at the bottom end of its range? That can determine how we're going to trade something and which strategy we're going to lose. And then how many days there are till expiration, okay? And where that really makes a difference is just on the delta and gamma accelerate much quicker the closer you are. The expiration is to the day you put it on the trade. And your exposure to vega is greater to movement and the implied volatility the farther out you are. So, gosh, we're approaching 2 o'clock. Does anybody have any questions? I'll answer any questions you may have. And it doesn't necessarily have to be related to strike price selection or I'll even answer strike price selection, but month expiration selection, whatever questions you may have, be very happy to answer. Okay. Oh, we have one here. Okay, somebody said they're confused to what the optimal month to buy. There's no such thing as an optimal month. And I realize that sounds like a very flippant answer, and it is. What's important is what your strategy is. I mean, if you're trading equities, one thing that's very important to know when you're doing a strategy is when are earnings, okay? And you'll go, well, what do you mean, when are earnings? Well, remember that matrix. I'll show you what I mean. I'll take half a step back. The optimal month to buy depends on your strategy. Are you trying to bring in premium by selling premium? or are you trying to make money on a move within a certain time premium? So, or time period. So, I mean, as I said, you're confused on the optimal month to buy. It depends if you're selling premium or buying premium. If you don't want to sell premium now, July premium, and I'll explain. Let's see, what's a stock with high volatility? I'll come up. Apple. If we look at the volatility here, chart, okay, and I look at it daily, I can tell you when earnings are. There's earnings, okay? Now, did I want to sell premium in the middle of April? You know, May or June premium. Here's earnings. You can go 3 months away from there. There's earnings. It's pretty predictable. Okay, we can see that because there's violent moves in the implied volatility. Okay, so I mean, that's a darn good question. And the optimal month, this is one reason I always suggest to my students that they trade the same underlying all the time, because there's a certain predictability based on the individual underlying. I mean, if you're trading Monsanto or Potash of Saskatchewan, it makes a difference when the crops get in the ground, what they're planting, what the expectations are, what the weather's like, okay, which does not affect Apple. You know, you trade pharmacy stocks, pharmaceuticals. There's FDA announcements. All these things can impact implied volatility, which is a crucial part. I think what's important, and gosh, that's a good question, is what your goal is, what the underlying is, and what your scenario is, okay? And so the optimal month, and I can't tell you, because on each individual stock, I'll go through on an individual stock and do what if, okay? And you'll go, well, what does that mean? That means I'll go through and I'll do a trade on, you know, I'll change the strike prices. I'll change, so, you know, gosh, do I want to do a 400, 420 vertical, or a 405, 425 vertical? Do I want to make it wider? Do I want to make it narrower? I'll go through what if. And an example of that would be, I quite often will look at a position and that one of my students have put on, and I'll say, now, why'd you pick that one? Well, it looked good. Well, did you look at any others? Well, no, this one looked good. Yeah, it looks good, but it's amazing, and I fall prone. I can, you know, do the same thing, and we'll sit there and we'll say, well, geez, what if? And I'll go through and we'll look at other alternatives and go through an exercise where, you know, we analyze it and we walk through the, you know, here's something, you know, I go -5, okay, I think we aren't going to go up. 5. Analyze. Okay? Okay, what happens if volatility goes down? Okay, and we'll say, right now I know that the implied volatility is running right around 28. Okay? I also need to check, if I'm trading Apple, I need to see when earnings are. Okay? And so that becomes an exercise where I'll go, just to go back, but it makes a difference. Okay, right now, this is from last time, so I can be pretty sure right now that there's a good chance at 723 after. Okay, July earnings are, or July expiration's 421. So I'll go and check and see if they've announced the earnings, if it's going to be after expiration or before expiration. But I'll go through a number of iterations saying, okay, do I want to do this, or you know, do I want to move this up, 25 points? Okay, analyze, and I'll start looking. Oh, I screwed that up. How did I do that? Okay. Oh, who knows how I did it. -5. Oh, I know what happened. 5, 0, analyze, superimpose. Okay, and I'll look at this and I'll say, okay, I feel comfortable because I'm a bit concerned to the upside or whatever. But I will look at this over price and time. What happens if volatility goes down too? I can look at these and start stepping through these positions and seeing how they look. And it's nothing for me to look at 6 or 7 of them or more, and then I'll go, well, gosh, do I want to do this or do I want to do this one? Okay. I'll click on here, this highlighting that, and I analyze, and then I superimpose. And it's sort of like, well, gosh, I don't know how much I really buy by going 1 month out on a vertical because I'm looking for a move, okay? But, I mean, it is confusing because I can't give you the answer of what's the optimal. And it comes down to the fact that all option strategies work, but they don't work all the time. I don't think I did much to reduce your confusion, did I, Dave? Any other questions? What are the factors then to determine which month to buy? It's your own personal scenario, what you think is going to happen. And I would say which month to trade because you may be buying, you may be selling. So if it's an individual stock, it could be dividends. It's definitely earnings take a matter, and earnings are like a historical impact. You can figure out what's going to happen there. So you have micro things that are important. You have macro issues which are important. I know people that will not trade weeklies the week of the monthly jobs report, which is the week with the first Friday of the month. So that would be, and you'd have to look at the schedule, but they would not trade the options expiring the first Friday in July, August, September. Sometimes it goes to the second Friday, but that's rare. I don't know what the rule is. But it's all about what can be happening on a macro scale or a micro scale. And I wish, I could be more definite about it. That's one of the reasons that when we have people trading option strategies, we prefer that they do what we call scrimmaging. Trade small lots. I can't tell you how many guys I've seen trade 1 contract, then go to 5 contracts, and the next thing you know, there's a 100 contract position on, and the proverbial chickens hit the fan, and they don't know how to react. So there's a learning curve on how you deal with the bad things that happen to you. Okay? So I hope that helps. Over time you'll find out what are the differences that in fact make a difference in the success of your specific strategies. Because we all come up with strategies that we want to use, personally want to use in different environments. Okay? Somebody always said, and this is Jim, you can see the webinars that are scheduled on the front page. Okay? So I'm going to close, or trade the close here. I got to go through and do my what-ifs for the last hour. thank you very much for coming. If you want a list, that sheet that I mentioned before, okay, I'd be happy to. And where is this? Of course I can't find it. What the options do, not options, but the underlying does when dividends go up, dividends go down, stock price goes up, stock price goes down. We can go through it. I would be happy to send that to you so you can have your own individual copy. In addition, I'll send a copy of an options calendar, which is very helpful in determining when expiration is. So thanks again for stopping by. Have a great time, and thank you for spending an hour with me this afternoon.